when China threatened to strike back at the United States with new tariffs and export controls. It was meant to send a clear message. We can hit you where it hurts. But what happened next took everyone by surprise. Instead of backing down, U.S. businesses responded in a way that no one, not even Beijing, expected. And that response might have just turned China's entire strategy upside down. Because this time, the threat didn't cause fear, it caused change. Today, we're breaking down how China's latest tariff and export threats might have completely backfired, and how American companies are quietly reshaping the global trade map in response. Rising tensions between two giants. The U.S.-China trade relationship has always been complex, a mix of rivalry, dependence, and uneasy cooperation. But in 2025, things hit a new low. After years of disputes over technology theft, semiconductor bans, and sanctions, China unveiled its latest move: new restrictions on the export of rare earth minerals, the materials used in virtually every advanced product on Earth. From smartphones and electric vehicles to missile systems and satellites, rare earths are the backbone of modern technology. And China produces around 70% of the global supply. The message from Beijing was clear: if Washington wanted to keep escalating tariffs, China could retaliate by cutting off access to the very materials that power the U.S. economy. On paper, it sounded like a powerful play. But in reality, it may have been the move that finally pushed America to break free. America's unexpected response: instead of panicking, many U.S. companies responded with calm, strategic precision. They didn't wait for Washington to act, they acted themselves. From Silicon Valley to Detroit, boardrooms across the country made a decision. It was time to prepare for a world with less China. Manufacturers accelerated plans to move production to Southeast Asia, Mexico, and even parts of Africa. The China Plus 1-inch strategy, once a slow-moving corporate trend, suddenly turned into a global race. Major companies began scouting new suppliers, signing long-term contracts outside China, and building factories in countries like Vietnam, India, Malaysia, and Indonesia. Even American tech firms, which rely heavily on Chinese assembly lines, started investing in diversification. It wasn't about cutting off China overnight. It was about reducing risk and sending a quiet but powerful message: go ahead. Make your move. We'll adapt. Stockpiling and strategic preparation. In the short term, retailers and manufacturers rushed to secure goods before tariffs took effect. Warehouses across the U.S. filled up as companies imported record volumes of electronics, auto parts, and consumer goods ahead of the new 100% tariffs. It was a costly move, but it bought them time. And time was exactly what they needed to adjust supply chains, renegotiate contracts, and strengthen relationships with alternative partners. Even though logistics costs surged, businesses understood that short-term pain was better than long-term dependence. Legal and political pushback. Meanwhile, another battle was being fought in Washington and in courtrooms across the country. U.S. companies and trade groups didn't stay silent. They filed lawsuits challenging the legality of broad tariffs and pressured lawmakers to design smarter trade policies that wouldn't punish American consumers. Associations representing retailers, manufacturers, and tech giants warned that blanket tariffs would hurt both sides, but they also demanded policies that encouraged domestic innovation and supply chain independence. Even some investors, normally cautious about politics, began speaking out. They pointed out that every time tariffs rise, global uncertainty follows, and that uncertainty is now the biggest threat to stability. So instead of lobbying for softer policies toward China, many businesses began lobbying for more investment at home. Investing in independence, this was the real turning point. As Beijing tried to weaponize its control over rare earths, the US and its allies started pouring billions into breaking that control. New mining projects began in Australia, Canada, and the US itself. Recycling programs for rare earths expanded. Engineers looked for synthetic substitutes and new refining techniques that could cut dependence on Chinese processing plants. What had been a long-term plan suddenly became an urgent mission. And here's the irony. By trying to use its resource dominance as leverage, China may have triggered exactly what it feared: the world's biggest economies investing in ways to stop needing China altogether. Already, several US and Australian companies are collaborating on advanced refining projects. Japan and South Korea are also joining forces to secure critical materials independently. The global supply network that once revolved around China is slowly, but surely, starting to reroute. China's plan backfires inside China. The effects are beginning to show. Exporters who relied heavily on US contracts are reporting cancellations. Orders are being redirected to suppliers in Southeast Asia. Even Chinese investors are quietly admitting that the country's reputation as the factory of the world is starting to erode. By flexing its power, Beijing reminded the world of exactly why dependence on China is risky, and that realization may be impossible to reverse. Some analysts now believe that the next decade could see China's share of global manufacturing fall, as companies diversify for political and economic safety. So, what was supposed to be a display of strength might actually be the start of China's industrial decline, or at least a major slowdown. Short-term pain, long-term gain. Of course, this transition isn't painless. In the short term, tariffs mean higher prices for US consumers. Import costs rise, and certain products may become harder to find. But businesses are playing the long game. They're betting that building resilient, diversified supply chains will pay off, even if it takes years. Economists call this strategic decoupling. It's not about ending trade with China completely. It's about ensuring that no single country can ever hold the US economy hostage again. It's a new form of globalization, one that prioritizes resilience over efficiency. The bigger lesson what this entire episode shows is that in today's interconnected world, economic power isn't absolute. China tried to use its dominance as a weapon, but that weapon may have cut both ways. Because when you push too hard, you give your rivals the motivation to innovate, to invest, and to find new paths forward. And that's exactly what US companies are doing. They're proving that global trade isn't just about who controls the most, it's about who can adapt the fastest. So as China and the US continue their economic tug-of-war, one thing is becoming clear: the world is changing faster than either side expected. And for the first time in decades, America's businesses aren't just reacting, they're leading the shift. China's threats might have sparked fear at first, but in the long run, they may have sparked something even more powerful: determination. If you found this breakdown insightful, hit like, subscribe, and ring the bell, because the next phase of the US-China trade showdown is going to be even bigger. And we'll be here to break it down every step of the way.